What's up, Squares? Harold Perkins here, and today I have more tips for first-time homebuyers. Choosing the right mortgage can be overwhelming, but understanding the different types of loans with the help of your mortgage broker can make it easier. The most common loan is the conventional loan. This is like 80% of the loans that are done in the US. This type of loan is not insured or guaranteed by the government, which means the lender assumes more risk.
Risk? What risk?
So guidelines on the conventional loans are going to be stricter than the other types of loans that are available to you. I'm sure you've heard of Fannie Mae and Freddie Mac. These are your conventional loans. Fannie and Freddie set the underwriting guidelines, and if you meet these guidelines, then they will buy the loan from the lender that gave it to you. Conventional people tend to have higher credit scores, larger down payments, and lower debt-to-income ratios. And you can get rewarded for that in the form of lower closing costs, lower mortgage insurance cost, and lower interest rates in most cases.
Interest rates, and so on.
So the interesting thing about conventional loans is that the underwriting decision is rarely made by a human underwriter. Yeah, that's right. Fannie and Freddie both use an automated underwriting system to determine whether or not your loan should be approved. Fannie's system is called Desktop Underwriter, or DU. Freddie's system is called Loan Product Advisor, or LP for short. And while Fannie and Freddie's systems will allow for a human underwriter to make the underwriting decision, almost no bank in the country will do this.
Why is that?
Yeah, why is that?
You see, when a bank is giving you a mortgage, they are rarely keeping that loan on their books. Their goal is to sell your loan to Fannie or Freddie so that they can use that money to lend to somebody else. The bank makes a little bit of money in fees when you take the loan, but they make even more in fees when they sell that loan to Fannie or Freddie. Well, if the bank uses DU or LP for the underwriting decision of your loan, then Fannie and Freddie pretty much guarantee that they'll buy that loan from the bank.
I'll buy it!
Well, the bank wants that guarantee. They don't want to be stuck with your loan on their books because then they can't lend that money to someone else to collect more fees. Do you even care about this? Does it even affect you? Yeah. So the problem with DU and LP is that it can only read the data that's been input into it. It's an algorithm. Well, if the data is input incorrectly or it's wrong, well then that can lead to an unfavorable decision from DU or LP. And most banks have a policy that a human underwriter cannot override the automated decision. Yeah, that's right. A human underwriter can correct inaccurate data based on the documentation that's provided and rerun it through the system, but the underwriter cannot actually make the decision on their own.
I am absolutely paralyzed by decision making.
So when you pick your mortgage broker, they need to have an expert understanding of how DU and LP work and how to input that data into those systems. Over my career, I have personally closed dozens of loans for people who were declined by another lender solely because their data was not input into DU or LP correctly. It's astonishing to me. Okay. What about FHA loans? FHA loans are backed by the Federal Housing Administration, and they are popular among first-time homebuyers, although you don't have to be a first-time homebuyer in order to use it. Because these loans are insured by FHA, there's less risk to the banks, so now we can talk about lower down payment requirements and more lenient credit score requirements. For example, if your credit score is below 620, then you're looking at FHA as your best option for loan program. If your credit score is lower than 580, then you are definitely looking at FHA for your loan program, but the down payment requirement goes up to 10% of the sales price.
Yeah, is it reasonable?
FHA is also reasonable when it comes to things like prior bankruptcy or foreclosure. There's a 3-year wait period after foreclosure for FHA, whereas conventional is going to make you wait 7 years. So for foreclosures, FHA is like the cool uncle who will give you a beer on your 16th birthday. But conventional is like that helicopter parent who's not going to let you get away with anything. A Chapter 7 bankruptcy requires a 2-year wait period for FHA, but it's 4 years for conventional. And you can actually be in a Chapter 13 bankruptcy with FHA, but conventional is going to make you wait until 2 years after that Chapter 13 is discharged. The other cool thing about FHA is that automated underwriting approval is not required. Remember how the conventional underwriters do not have the authority from their bank to override the automated systems. Well, FHA underwriters do, and they do it all the time. Yeah, that's right. FHA underwriters are encouraged to use a little bit of common sense when it comes to making a decision as to whether or not to approve a home loan.
Common sense, how appropriate.
Here's an example. Let's say you had a time 3 years ago where you lost your job. Since you had no income, you got behind on your bills and a few things went to collection. But 2 years ago, you got your dream job and you got everything caught up, and there's been nothing derogatory reported on your credit for the past 2 years. Well, on a conventional loan, you still might not get approved. Now, I'm not saying that you shouldn't try, I'm just saying that maybe your credit score hasn't improved enough yet for DU or LP to approve a conventional loan. But FHA is different. It understands that people can hit rough patches in life. But if you show an FHA underwriter that everything has been perfect for the past 2 years, they will always approve your credit regardless of how bad things were in the past.
Time heals all wounds.
And credit history. But FHA has a dark side too. The problem with FHA loans is regardless of the amount of equity you have in the house or the amount of your down payment, you are paying mortgage insurance as part of the loan. Yeah, that's right. We all know that if you put 20% down on a conventional loan, then you do not have PMI as part of your payment. But you do for FHA, and FHA also charges an upfront mortgage insurance of 1.75% of your loan amount. So on a $300,000 loan, that's $5,250 just in MI when you close. It's pricey.
Sounds expensive.
But if you have a lower credit score or a prior bankruptcy or foreclosure that's not old enough for you to be eligible for a conventional loan, then FHA is the way to go. The thing is, I know that no one wants to pay PMI, but conventional loans charge a much higher interest rate if you have lower credit scores. FHA does not do that. So if you have a lower credit score, it could be less expensive to pay the PMI on an FHA loan than it would be to pay the higher interest rate on a conventional loan. Your mortgage broker is going to help you with this so that you can compare and decide which option is going to be better for you. And then there's VA loans. VA loans are the best. If you're eligible for a VA loan, stop looking. That's the best option every time. This video will tell you why. USDA loans are guaranteed by the rural housing part of the U.S. Department of Agriculture. These loans offer 100% financing at lower interest rates and very low PMI.
That'll do, pig. That'll do.
However, you need to meet income and property location requirements to qualify for a USDA loan. For example, where I live in the Phoenix area, pretty much nowhere is eligible for a USDA loan. Well, that makes sense because I live in a city, which is the opposite of rural. You can check your area's eligibility for USDA as well as the income requirements at this website. If you and the house that you want to buy is eligible for USDA, then you would choose this loan program over FHA. Jumbo loans are for people who need to borrow more money than the conforming loan limit that's set by Fannie Mae or Freddie Mac. That's currently $726,200 in most areas. These loans have higher interest rates and stricter underwriting guidelines than other types of loans because they can't be sold to Fannie or Freddie. So that means the bank's on its own and is taking all of the risk for that loan.
I'll take the risk.
So you're paying for that in the form of a higher interest rate and the stricter underwriting guidelines. Generally speaking, jumbo people don't need too much advice from me, but here's one nugget to consider. Let's say you need to borrow $800,000, but the conforming loan limit in your area is $726,200. Instead of doing one jumbo loan at a higher interest rate for the entire $800,000, we're going to split that into two loans. Yeah, that's right, a first mortgage of $726,200 in order to get the conforming interest rate. And at the same time, a second mortgage of $73,800 for the total of $800,000. So yes, you would have to make two mortgage payments, but the total of the two mortgage payments would be less than the one payment at the higher interest rate for the entire $800,000. And then finally, there are the non-QM loans. Non-QMs are all of the alternative documentation type loans. That's things like using your bank statement deposits to document your income instead of your pay stubs, or DSCR loans, or maybe 1 year of tax returns to document self-employment instead of the traditional 2. But this is the end of this video, so you gotta subscribe or follow to catch the next one on non-QM. Later, nerds.